Add myself to the stream here. Hello, everyone. Hello, everyone. I hope that you all are doing well today. Um, I went live earlier, going live again because information just comes in and out throughout the day. So, want to share my perspective and just kind of some new information that I'm just gathering so that you all can see, like, kind of my process for gathering information and the information that I gather, so y'all can see that. So, I'm going to go ahead and drop the intro. Please comment down below if you are joined with me today. If you're live with me, we're going to get into some important information. As many of you all know, that we have talked about recession and we talk about gold, and so we want to see what is the likelihood of recession coming and how will gold perform in the recession. So we'll get back to it after I drop this intro. All right.
Think. Act. And prosper. You are now tuned into the Money Level Show.
All right. We are back. We are back. So I was recently reading in Lynn Alden's article where she talked about liquidity and where liquidity is at. For those that don't know, liquidity is pretty much what drives the valuation, the value of stocks and such. When people have more liquidity, they are more likely to invest, and that pretty much pushes up markets and such. But currently, liquidity is flat. It has not been up. Liquidity is actually being drained due to the Fed hiking rates and selling government debt off their balance sheets, which is called quantitative tightening. And the government is refilling the Treasury General account, which means that they are issuing short-term T-bills to draw money out of the system into their hands, and they promise to pay back that money. So that is liquidity. And so I was reading about that, and she did post um, the leading economic index chart, which pretty much shows it's a basket of metrics, but it pretty much shows that recession is still coming. And so we're going to look at what is the economic leading indicator index, and we're going to get into that first, just so that we know what we're looking at and everything, because I think that it's important that we understand it. So let's go ahead and jump over there. Hello, whoever's viewing right now, please drop a comment that you are here. We'd love to shout you out. All right, so we're going to jump over to our first article here. All right, here we go. I think this is it, right? All right. Classic article, Investopedia, which it's very helpful for those that don't know. All right. So what is the composite index of leading indicators? The composite index of leading indicators, otherwise known as the leading economic index, is an index published monthly by the Conference Board. It is used to predict the direction of global economic movements in future months. The index is composed of 10 economic components, whose changes tend to precede changes in the overall economy. Businesses and investors can use the index to help plan their activities around the expected performance of the economy and protect themselves from economic downturns. All right, so understanding this is very important. So they have the 10 components that make up the LEI, which is the leading economic index. Number one is the average weekly hours worked by manufacturing workers, indicate consumer income and business demand for labor and engage in ongoing production. The average number of initial applications for unemployment insurance indicates possible changes in unemployment, which reflects the level of business activity and affects consumer income. The volume of manufacturers' new orders for consumer goods and materials indicates businesses' short-term operational spending. The new orders index from the Institute of Supply Purchasing Managers Index indicates whether orders for various manufactured goods are increasing or decreasing. The volume of new orders for capital goods, except aircraft, unrelated to defense, indicates business plans for longer term future production involving durable capital. The number of new building permits for residential buildings indicates future spending on construction products. The S&P stock index indicates the total value of business sector and nominal wealth of stockholders in the economy. The inflation adjusted monetary supply, M2, indicates the purchasing power of highly liquid assets available in the financial system for business and consumer borrowing and spending. The spread between long-term and short-term rates, including bond market participants, and average consumer expectations for business conditions, indicate forward-looking consumer sentiment for the next 6 to 12 months. So now, this gives a lot of information, right? This one chart compiles many factors into one chart, and so it's very important that we understand that when we look at this chart. And so we're going to go ahead and jump over to the chart and see what it says. All right, here we go. All right, wrong screen, my bad. Let's go to the right screen. All right, here we go. I believe this is it. Here we go, the conference board. So the latest release was Thursday, July 20th, 2023, and we're going to jump down to the chart. Excuse me. So now the chart is here. As you can see, in recessionary periods, which you see right here, this gray bar, these are obviously the 2001 dot-com recession, the global recession, the global financial crisis, the Great Recession from 07-09. Then you have the short one in 2020, which the Fed printed us out of, right? So the LEI, the leading economic indicator, is the blue line. So the blue line dips whenever there is a recession. And it is said that a recession follows pretty much 12 months after it dips, right? So as you can see, it dipped during the 01 recession, and then it dipped again in the 09, and then it dipped again during COVID. And right now it is at the those same levels. So we see that the indicators are showing that recession is on the horizon and that it is likely to occur. The gray line here is the change in GDP. GDP usually dips quite a bit. So it went from 5% to 0%, and the .com, it went from, I don't know what, 2.5% to almost negative 4.5%, negative 4% in the global financial crisis. It came way down during the pandemic. And right now it is staying hovered at around a little less than 2% or whatnot. And so this could dip, any quarter, and we could end up in a recession. So the leading economic indicator is showing that recession is coming. Recession is coming. And so we have to look at what can we do, whenever a recession is going to come, right? And so the article that we just left from Investopedia does give some tips on what we can do. We're going to look at that, and then we're going to look at what gold does. How does gold perform in a recession? So let's go ahead and jump over to the previous article. All right. Doom. All right, so the previous article, they have some questions on here, which are pretty practical. How can I prepare myself financially for a recession? Recessions are difficult periods with increases in unemployment that occur during an economic downturn. Job security can be a serious concern. Part of preparing for a recession might be shoring up your emergency fund. This way, if you do lose your job, you can cover your expenses for a few months without dipping into your savings or investments. Now, Rick has been on multiple times talking about like the importance of having cash, the importance of having cash. Obviously, Rick does view gold as a form of cash, but you do have to be liquid. You do want to have liquid cash. And so, and he's also went on Stansberry and said people need to get their financial house in order. So having an emergency fund is very, very important, so that you have savings, and if you lose your job, you can be good, right? Um, how can I protect my investment portfolio during a recession? Economic downturns are stressful for those worried about their investment portfolios. I mean, obviously, people lose a lot of money in their 401ks. They see huge balances um, drawn down, and everything. And so, yeah, it's bad, right? And so, economic times won't last forever, which that's important to note. But if you own a diversified portfolio, you may benefit simply from holding on to your investment until the economy recovers. So, what is a diversified portfolio? That is not being in all growth stocks. That is not being in all tech stocks. You want to be in stocks that are like that produce. You want to have value stocks. That actually produce some things and sell some things that can perform well in a recession. You want to have stocks like gold stocks or whatnot. They can perform well during a recession. So you want to be fully diversified. You don't want to just be in one sector, right? And so that's very important. So who's here watching? Somebody's here watching. I see a couple people in here. Would love to have your input on this conversation. And then, so now we're going to talk about how does gold perform in a recession, because that's very important too. I mean, I own a lot of gold. I own it for insurance, right? I speculate with gold stocks. I own physical gold for insurance, because if the dollar collapses, you want to have gold, right? Gold is money. Gold is real money, right? And so these other fiat currency papers and stuff, they can go to zero. They've went to zero multiple times throughout history. So you want to own gold, physical, tangible assets, right? That hold value. That's my take on this. So let's go ahead and look at what gold does during a recession. All right. This is from goldpriceforecast.com. All right. So here we see this chart. This chart goes back to the 70s. It does not show the 2020s. It goes to January 15th, which the 2020s we saw gold go up, right? So this is the price of gold during recession. So these bars here, the yellow bars, are what are the recessionary periods. So obviously we had the 70s. Here, gold was taken off the gold standard. It went up during that first recession, came down, and then you had the next recession, which was in the 80s, right? Paul Volcker hiked up rates very high. The economy went to a deep recession to get the inflation out of the system. Gold went up again, right? And then it came down again, and then we had another recession, right? This must have been a very challenging time. I don't know if any of the viewers here watching have been through this time, but this seems like a very challenging time. I mean, within 3 recessions in 10 years, right? And then gold went up again. Then it came down, right? Went up again before the 90s. Then you had the recession of the 90s, which this gold's kind of stayed flat during that period. It stayed flat for a good 10 years. And then you had the dot-com bubble. Gold went up again, came down a little bit during the global financial crisis, and so went to skyrocket to new highs at that point. And then obviously we saw during COVID that the gold price came down around this level in 2015. Then we saw when the pandemic hit that gold went up higher again. So gold obviously performs higher during recessionary periods. This is pretty obvious, except in the 90s it kind of stayed flat to a little bit down. But you can see these little dips in gold too. And what that is that the gold price does dip temporarily when people need liquidity. when recession hits, they sell everything, they sell assets, and then they will sell their gold. And the gold price does fall, but it does bounce back sharply. We saw that in 2020. 2020, I remember vividly seeing gold at what, I forgot the price. I was buying it at that point, but then it went back up to hit all-time highs, right? And so yeah, so gold does go down, but then it shoots up because it's meant for that. I mean, it's meant to be a hedge against uncertainty, economic uncertainty, but sometimes people need that liquidity, right? People need that liquidity. So I hope this was helpful as we got into this today. Um, I think that owning gold helps during the recession, and it will protect you. However, it does take a dip, and if you got cash, you can buy. Right, you can buy some of these assets cheap. You can buy gold cheap. You can buy stocks cheap and such. So you got to have capital available to deploy during a recession. So stacking some cash, putting it into a savings account where you can earn interest, or buying short-term treasuries, which is what I do, both of those. Is very important. So I hope that this was helpful today. Be sure to hit the like button and subscribe. Hit the join button to become a member. This is a new feature of my channel where you can access the videos and interviews that I do with some of your favorite people that you love to watch early. It only costs $6.99 a month, $6.99 a cup of coffee. Be sure to hit that join button and support me. Support me. And you also get to have priority whenever you ask questions to some of the interviewees and some other perks. But you can hit the join button or hit the link. I'll have the link in the description below. I want to thank you all for joining me today, and I hope that you all have a good day. And I hope that this video was helpful to understanding if we're going into recession, and if we do go into recession, how will gold perform, right? All right, y'all take care. All right, peace.